This video will break down what I'll dub are the 4 natural laws to investing, aka principles I'd recommend adopting for long-term investing success. If you don't know who I am, my name is Chris Dime. I'm a financial planner out of Edmonds, Washington, and I specialize in working with folks to and through retirement. Now, whether you're brand new to investing or a seasoned veteran in putting money into the capital markets, most professionals would advise adopting some level of investment philosophy, aka a more objective way of making decisions and a view of the markets rather than ad hoc, emotionally based investment selection decisions. So in today's video, I'll break down 4 natural laws of investing that if you adopt should ideally foster more long-term investment success. It's panned out well for myself, it's panned out well for my clients over the past decade, and it's got hundreds of years of data to back it up as well. So let's jump in. Now, there are of course an infinite number of various philosophies out there. There's not just the 4 natural laws we'll touch on in a second. There's investment philosophies such as technical analysis, and that'd be where you ultimately follow a stock chart of a particular security and then make an investment selection based on, how the trends are moving along. For example, maybe you see the stock's gone up, then down, then up, then down. Oh, I wonder what it's going to do next. So in the anticipation of it going up, you'd therefore buy the stock. There's other philosophies like fundamental analysis, and that's where, as opposed to looking at the stock charting of that particular security, you rather look at those companies' financials and then make a decision based on fundamentally what's happening with that company. For example, maybe you've seen over the past decade that sales are through the roof, but the headcount for folks in the quality assurance space has been plummeting, and maybe the reports that are coming back relative to quality are lower than expected. There's of course another philosophy out there called the efficient markets hypothesis, and personally this is where I have a bias, but it's essentially the philosophy that you can't outperform the market reliably over the long term, so you might as well not try to beat the market, you might as well try to match the market and potentially mitigate risk through things like diversification. Of course, implicit in this philosophy is that those other 2 philosophies don't work over the long term. It's essentially the view that the markets overall are fairly efficient and you're not going to find blips in that efficiency through stock selection and market timing. Now, those are more meta-level philosophies on investing, but of course there's even more specific investment philosophies, such as whether or not your portfolio should be encompassed with individual stocks that ideally would outperform things like mutual funds or index funds. There's of course philosophies out there that maybe you should run as all mutual funds, because you might not pick the best stocks, but at least you can pick the best batches of stock, maybe AI-focused investing, mutual fund, tech-focused investing, mutual fund. And so maybe your philosophy lends you more towards mutual funds. Lastly, again, my bias is to take the more index fund approach to investing, whereby rather than thinking you can pick the best stocks, or at least pick the best sector of stocks via mutual funds, instead you'd pick the markets that are overall going to perform well. And that'd be through index investing into a particular index fund. You can see that the individual investment selection and the more meta-level philosophies are probably correlated, right? If you're an efficient market hypothesis person, you're probably also going to lend yourself more towards index funds, but not necessarily, and you could theoretically combine a few different philosophies together. And the beauty of all these philosophies is that they all outperform each other. The key is just to pick the right time horizon to use for a comparison, and of course the right individual stocks or particular market segments to compare. And while I might think certain investment philosophies are better than others, analogously to like a workout routine where you're trying to lose body fat, the data might pan out that low intensity steady state cardio is better than HIIT cardio for fat loss over the long term. But if HIIT cardio is what gets you in the gym, likewise, if a particular investment philosophy keeps you invested through thick and thin, well then that's the best investment philosophy for you. Whichever philosophy you pick, I would recommend adopting these 4 natural laws to investing. And this is not my native intellectual property. The 4 natural laws was actually taken from a speech that an advisor named Ted Shanahan over with Northwestern Mutual gave about a decade ago when he came to visit our Seattle office. The 4 natural laws to investing are: number 1, markets are cyclical. Number 2, one should always diversify. Number 3, one should rebalance their portfolio over time. And then number 4, you should dollar cost average over time. Let's briefly touch on each one of these 4 and then we'll call it a day. So number 1, markets are cyclical. Ultimately, what goes up in the investment space must come down, not necessarily vice versa. So particular companies that have gone down and stayed down forever and ultimately went bankrupt, those aren't going to come back up. But ultimately, as far as markets in general are concerned, markets are cyclical. What goes up must come down. Nothing goes up forever, which ultimately means at some point you should have an objective philosophy of taking chips off the table when your investments have performed well, aka sell high. Natural law number 2 is that diversification is key. Of course, unless you're the founder of Microsoft, Apple, Google, Coca-Cola, whatever. it's probably not going to be in your best interest to put all your eggs into one basket. And you could even argue the founders of these companies were also diversified because they had to have some level of company assets in cash to make payroll, right? So even they were diversified to some degree. In reality, as it pertains to your investment portfolio, it's going to pay dividends, pun intended, to have your portfolio divided into different market segments rather than all of your eggs in one basket. Relative to natural law number one, if we are diversified amongst different investments inside of our portfolio, then since natural law number one, markets are cyclical, generally there's going to be winners and losers in your portfolio. Now they might all be losers, but some might lose worse than others. And in that regard, some things are going to be up and some things are going to be down all the time. Natural law number three is that we must rebalance over time. What that means is, as opposed to keeping your portfolio invested in the same stuff forever, over time your portfolio is going to get a little bit out of whack. If we take a very simple portfolio, that's say 60% S&P 500 index fund and 40% US aggregate bond index fund, over time your portfolio will no longer be 60% in the stock-oriented portfolio and 40% in the bond-oriented section. Over time, that's going to turn into maybe 70% stock, 30% bond, or 50% stock, 50% bond portfolio. Over time, you're going to want to do what's called rebalancing, which is where you sell out of things that have done well relative to the other section of your portfolio and buy into the segment of the portfolio that's not done so well, ultimately bringing your portfolio back to homeostasis, or in this example, 60% S&P 500 index fund and 40% US bond index fund. In conjunction with natural laws 2 and 1, if you're looking to rebalance and you're very well diversified amongst a few different types of markets, and you know that markets are cyclical, well, that gives you lots of opportunity for rebalancing and selling winners and buying losers, knowing that over time, the losers you're buying into will be cyclical and come back up in the future. It makes buying low and selling high way easier. Natural law number 4 is to dollar cost average, which is just a fancy financial term for invest a similar amount of money periodically on an ongoing basis. AKA, don't put all your money into the market and then try to market time when you're going to dump new cash in. Similar to stock trading, in my opinion, the math on that doesn't pan out long term. And so you're better off investing the same amount or more on a consistent basis rather than trying to time when the markets are down. That's when I'm going to buy in, or I don't want to buy in before there's a crash, etc. Employer-sponsored plans like 401k plans do this very easily because they just suck money straight out of your payroll. But you could also replicate this on your own through monthly contributions from your checking account into your investment account, or if you have a bunch of money in like a money market account, you could easily set up an automatic transfer where you shift over a few $100 or a few $1,000 every single week or every single month from your money market account or high yield savings account into the capital markets. Dollar cost averaging makes a lot of sense, especially from a tax efficiency standpoint. If you think of like an individual investment account that's not a retirement account, as money grows and is sold and stuff like that within the portfolio, you're going to generate things like capital gains. And as opposed to paying taxes on capital gains, where you sell a particular security and buy a loser, right? Because markets are cyclical and they're going to come back up. Instead, you can take new money and deploy that into your portfolio to help it rebalance and stay diversified. This helps you avoid selling securities to rebalance, but rather putting new money in, thus saving you the taxes you otherwise would pay if you were to sell that security. And back to natural law number 1, if markets are cyclical, over time, you're going to be investing money at a lower share price than whatever the share price will be in the future on average. So it makes sense to consistently put new money into the capital markets. So ultimately, whether you adopt the philosophy of technical analysis, fundamental analysis, efficient market hypothesis, individual stocks, mutual funds, index funds, if you can adopt these 4 natural laws to investing, I think it'll very much simplify your investment selection and your decision-making process, ultimately bringing you more peace of mind so that you're not concerned about making ad hoc, emotionally reactive decisions if the markets go haywire. And let's face it, if you look across the globe, markets are going haywire all the time. There's always something that's going to attract your attention, and there's always the next cliff that everybody's headed towards. So from a calls to action standpoint, you don't need to type up your investment philosophy manifesto and laminate it and put it next to your computer. Instead, I'd recommend something simpler, like sharing your investment philosophy with a friend, coworker, spouse, etc., ultimately to help keep you accountable. So if that was helpful, if you have further questions, drop them in the comments below or get in touch on the website. We'll help you get squared away. Have an awesome rest of your day. Talk to you later. Bye.